If you were born before 1990, you are almost certainly leaving money on the table every single year, not because you made a mistake, but because nobody ever told you these rules existed. Right now, as you watch this, there are benefits, exemptions, and refunds that you are legally entitled to claim, and most people in your generation have never touched a single one of them. In the next 10 minutes, I am going to walk you through 5 specific financial advantages that were designed for people born before 1990. At least one of them applies to your situation right now. Possibly all 5. We are talking about real money. Hundreds, sometimes thousands of dollars per year that you are currently handing over unnecessarily. And the system is not going to call you. Nobody is going to knock on your door and say, "Hey, you've been overpaying." That is not how this works. So let me break this down for you one by one in plain language. No jargon. No fine print. Just the facts you need to stop the bleeding starting today. Before we dive in, I want to be completely honest with you about why this channel exists. Tax rules change. Benefit thresholds change. What applied last year may not apply the same way this year. We track these updates constantly so you do not have to. If you want to make sure you never miss a rule change that could cost you money, hit subscribe right now. There is no obligation. You can leave anytime. But the people who stay current are the ones who keep more of what they have earned. Alright, let us start with number 1. Number 1. The senior earned income credit expansion that most people born before 1990 have never used. Here is the situation. You may have heard of the Earned Income Tax Credit. For decades, it was designed almost exclusively for working families with children. If you did not have dependent kids, you basically did not qualify. That was the rule for most of your working life. But that changed. And the change was significant. Starting in recent tax years, the age ceiling for claiming the childless Earned Income Tax Credit was eliminated entirely. That means if you are still earning any income, part-time work, freelance, consulting, even a small side income, and you were born before 1990, you may now qualify for a credit that could put up to $1,500 directly back in your pocket. Let me repeat that. Up to $1,500. As a direct credit. Not a deduction. A credit. Meaning it reduces your tax bill dollar for dollar. Now here is why most people in your generation miss it. For 30 years, the Earned Income Credit had an upper age limit. If you were older than 64, the door was closed. That age cap is now gone for the childless version of this credit. But the IRS does not send you a letter saying, "Congratulations, you are now eligible for something you were excluded from for decades." You have to know to look. The income thresholds to qualify are specific. For single filers, your adjusted gross income generally needs to be under around $17,000 to $18,000 in earned income to get the maximum credit. For married couples filing jointly, that threshold is higher. And the investment income limit matters too. If you have more than $11,000 in investment income, you cannot claim this credit. So it is most powerful for people with modest earned income and limited investment returns. If you think you might qualify, here is your action step. Pull out your most recent tax return. Look at your earned income number and your adjusted gross income. Then use the IRS EITC Assistant tool at irs.gov. Just search IRS EITC Assistant, and it will tell you in about 3 minutes whether you qualify and how much you could receive. If you filed taxes for last year and did not claim this credit, you can amend your return using Form 1040X. The IRS generally allows you to go back 3 years. That means 3 years of unclaimed credits, potentially recoverable right now. Number 2. The overlooked property tax freeze and assessment cap programs available in most states. Listen to this number carefully. Across the United States, there are state and county-level property tax relief programs specifically designed for homeowners who have owned and occupied their home for a certain period of years. Analysts estimate that only about 9% of eligible homeowners are actually enrolled in these programs. 9%. That means 91 out of every 100 people who qualify are paying full freight on their property taxes when they legally do not have to. If you were born before 1990 and you own your home, there is a very good chance you qualify for at least one of these programs. Some states call it a homestead exemption. Some call it a senior freeze. Some call it a circuit breaker credit. The names vary. The result is the same. Your property tax bill goes down, sometimes dramatically. Here is how these programs typically work. A homestead exemption removes a fixed dollar amount from your home's assessed value before taxes are calculated. If your home is assessed at $250,000 and your state offers a $50,000 homestead exemption, you are only taxed on $200,000. Depending on your local tax rate, that could save you $500 to over $1,000 per year. Then there are freeze programs. These lock in your assessed value at the year you enrolled. Even if your home's value doubles over the next decade, your tax bill stays frozen. For people on fixed incomes watching their neighborhood gentrify around them, this can be the difference between staying in the home they have lived in for 30 years and being forced out by rising costs. And circuit breaker credits are the most powerful of all. These are essentially state income tax credits that kick in when your property tax burden exceeds a certain percentage of your income. Some states will refund you a direct check if your property taxes are too high relative to your earnings. The shocking part is that in most counties, these exemptions are not automatic. You have to apply, and the county assessor's office is not going to reach out and remind you. They collect the money just fine without volunteers stepping forward. Your action step right now: open a search browser and type your county name or your state name followed by the words Homestead Exemption Application 2025. Look for the official government.gov website. Most applications take less than 15 minutes to complete. Some counties allow you to apply retroactively for prior years. Do not wait on this one. In many states, applications for the upcoming tax year close between March and July. Number 3. The retirement account withdrawal strategy that people born before 1990 are most likely getting wrong and paying an unnecessary tax penalty for. If you have a traditional IRA or a 401k, you are required to start taking money out of it at a certain age. These are called required minimum distributions or RMDs. And here is where a lot of people born before 1990 are losing money without realizing it. The IRS recently updated the life expectancy tables used to calculate how much you are required to take out each year. The new tables assume longer life expectancy, which means your required withdrawal amount is actually lower than it used to be under the old tables. Lower withdrawal means lower taxable income. Lower taxable income means a lower tax bill. But here is the problem. Many people and many outdated online calculators are still using the old tables. They are withdrawing more than the new minimum requires. And every extra dollar they pull out unnecessarily is a taxable dollar. Over 10 years, for someone with a $500,000 retirement account, using the wrong table can result in tens of thousands of dollars of unnecessary taxable income. If you had a financial advisor set up an automatic withdrawal schedule more than 2 or 3 years ago and you have not revisited it, there is a real chance it was calibrated to the old tables. And there is a second layer to this. Even beyond RMDs, many people born before 1990 are withdrawing money from their traditional accounts in the wrong order. If you have both traditional pre-tax accounts and Roth accounts, the sequence in which you draw from them matters enormously for your lifetime tax bill. Here is the principle. In years when your income is lower, maybe you have just retired but have not yet started Social Security. Those are prime years to convert portions of your traditional IRA into a Roth IRA at a lower tax rate. You pay a modest tax now to lock in tax-free growth forever. People who do strategic Roth conversions in their early retirement years can save enormous amounts over a decade. Your action step: contact your IRA custodian or your 401k plan administrator and specifically ask them to verify that your RMD calculations are using the updated 2022 IRS life expectancy tables, which are still the current tables as of this video. If you suspect you have over-withdrawn in recent years, consult a tax professional about whether any corrective strategy is available to you. The IRS publication 590B lays out the current tables in full. You can download it free at irs.gov. Number 4. The Medicare premium surcharge that hits people born before 1990 hardest and how to fight it. This one makes a lot of people genuinely angry when they learn about it. And they should be. Medicare has a premium surcharge called IRMAA. That stands for Income-Related Monthly Adjustment Amount. Here is how it works. Medicare looks at your income from 2 years ago to determine your premium for the current year. If your income 2 years ago was above a certain threshold, you pay more for Medicare Part B and Part D than the standard rate. For a single person at the highest income tier, this surcharge can add over $440 per month to your Medicare premiums. For a married couple, that can exceed $880 per month. That is over $10,000 per year in additional premiums, just because of where your income was 2 years ago. Now here is why this is especially brutal for people who recently retired. The year you retire, your income often drops significantly. You go from a working salary to retirement distributions or Social Security. But Medicare is still looking at your income from when you were fully employed. So for 1 or 2 years after retirement, you are paying sky-high premiums based on an income you no longer have. And the IRS and Social Security Administration do not automatically adjust this. They do not review your situation and say, oh, this person just retired, let us lower their premium. You have to tell them. You do that by filing a form called the SSA 44. It is called the Medicare Income-Related Monthly Adjustment Amount Life-Changing Event Form. On this form, you report that you have experienced a life-changing event, retirement qualifies, and you ask them to use your current lower income instead of your 2-year-old income to calculate your premium. People who successfully file the SSA 44 after retiring have received adjustments that immediately drop their monthly Medicare premium by $200, $300, even $400 per month. That is real money, starting the very next premium cycle in many cases. Your action step: go to ssa.gov and search for Form SSA 44. Download it. Fill it out with documentation of your income change, a retirement letter, a final pay stub, a statement of your estimated current year income. Mail it or bring it to your local Social Security office. There is no filing fee. There is no downside to trying. The worst they can say is no. Number 5. The capital gains exclusion that people born before 1990 who own a home are dramatically underusing. If you have owned your primary home for at least 2 of the last 5 years and you are considering selling it, there is a tax exclusion that could shield up to $250,000 in profit from federal capital gains tax, and up to $500,000 if you are married. This is called the Section 121 exclusion, and it is one of the most powerful tax provisions in the entire U.S. tax code. But here is what most people get wrong about it. Many people born before 1990 believe they can only use it once in their lifetime. That used to be true under an old law. That old law no longer exists. You can use the Section 121 exclusion every time you sell a primary residence, as long as you have lived there for 2 of the last 5 years. It resets. You can use it multiple times. A second mistake. People assume this only matters if they have a huge profit. But homes purchased in the 1980s and 1990s in many parts of the country have appreciated 2, 3, or 4 times in value. A house purchased for $150,000 in 1988 might be worth $550,000 today. That is $400,000 in gain. Without the Section 121 exclusion, a married couple would owe 0 federal capital gains tax on that entire amount. But if they did not know about the exclusion and did not structure their sale correctly, they could end up owing tens of thousands of dollars unnecessarily. And there is a third layer that almost nobody talks about. If one spouse passes away, the surviving spouse has a narrow window, typically 2 years, to sell the home and still claim the full $500,000 married exclusion. After that 2-year window closes, the exclusion drops to $250,000. The difference in tax exposure between acting within that window versus waiting just a few years can be over $60,000 in capital gains tax on an appreciated home. Your action step: identify when you purchased your current home and estimate what it is worth today. If there is a significant gain and you have any possibility of selling in the next several years, talk to a tax advisor specifically about Section 121 planning before you list the property. Decisions made before the sale can save you money. Decisions made after the sale generally cannot. Let me bring this all together for you now, because I want you to leave this video with something concrete. 5 advantages that people born before 1990 are leaving on the table every single year. Number 1. The expanded Earned Income Tax Credit. Check your eligibility at irs.gov right now if you have any earned income. Number 2. Property tax exemption and freeze programs. Search your county name and homestead exemption application today before deadlines close. Number 3. RMD calculations using updated life expectancy tables. Verify with your custodian and explore Roth conversion windows in lower-income years. Number 4. The Medicare IRMAA surcharge fight. File Form SSA 44 if your income has dropped since the year Medicare is using to calculate your premium. Number 5. The Section 121 home sale exclusion. It resets, it is powerful, and timing decisions around it matter enormously. Not one of these requires a lawyer. Not one of these requires an expensive accountant, though consulting one can certainly help. Every single one of these is a legal entitlement that exists specifically for people in your situation, people who have worked, who have paid into the system, and who deserve to keep more of what they have built. The system will not volunteer this information to you. That is just the reality. But now you have it. If this video was useful to you, share it with one person you know who was born before 1990. There is a very good chance they are in the same situation and have no idea. And subscribe if you want us to continue tracking these changes on your behalf. Tax laws shift every year. Benefit thresholds get updated. We will be here when they do.